Throughout the 1970s, nothing, and I mean nothing, enjoyed the astronomical gains that precious metals delivered. But, like the song says, baby, you ain't seen nothing yet. Chapter 7. Enormity Squared. The 70s. In trying to think of an analogy for the performance of gold and silver in the 70s, what comes to mind is a great asset race between stocks, real estate, gold, and silver. If those assets were horses, which one should you have backed? To get the maximum payoff, let's bet $1 on every asset when each asset is at its lowest price of the decade, and then we'll see what we would have collected when all four assets crossed the finish line in January 1980. Gold began our race at $34.75 per ounce in January 1970, then ran all the way to its $873 per ounce high on January 21, 1980. That gives an astonishing payoff for gold of $25.12 per $1 bet, basically 25 to 1. Silver started at $1.27 and remained in the single digits for most of the decade before making its move late in 1979 during the home stretch of our great asset race. And boy did silver take off, literally leaving the field in its dust and hitting the finish line at $52.50. Every $1 bet paid a whopping $41.27 profit. A $100 bet would have returned more than $4,000. To give you a true sense of perspective on just how far ahead of the pack the front runners were, this chart illustrates that real estate was just and also ran, coming in a very, very, very distant third, paying out just $2.29 on a $1 bet. But stocks were worse. From their low in 1974 until January 1980, the Dow came in a distant last, paying out just $1.44 for each $1 bet. Flogging a dead horse. Everyone loves stocks right now, that in the 70s they were like flogging a dead horse. The Dow bumped its head on 1,000 points in 1966 and didn't decisively break through until 1982, an anguishing 16 years and 10 months. For every dollar bet in 66, you still had only $1 in 82. But was it even the same buck? In the second chart, I've divided the Dow Jones Industrial Average by the Consumer Price Index. In other words, it's adjusted for inflation. The invisible crash. Even though the stock market's price remained relatively constant, it lost 73% of its value. Yes, 17 years after making a $1 investment, the value had dropped so much that you could only buy 27 cents worth of 1966 goods and services. This is known as the invisible crash, and it would take many decades before anyone would realize that it had even happened. Home on the range. In January 1970, a new single-family median-price home was $23,600 and gold was $35 per ounce. If you had sold a home then, you would have been able to buy 674 ounces of gold with the proceeds. By January 1980, the home that you sold almost tripled in price to $62,900. But over that same time period, your 674 ounces of gold rose 25 times, from $23,600 to $588,402. You could then have sold your gold and purchased 9 comparable homes and have had more than $22,000 left over to put in your pocket. But if you had sold the same home in November of 1971 and bought silver, by January 1980, your silver would buy 16 homes with almost $56,000 left over for the cookie jar, and almost 17 times gain in true wealth in just over 8 years. And that sure ain't hay. The winner's circle. Throughout the 1970s, nothing, and I mean nothing, enjoyed the astronomical gains that precious metals delivered. But, like the song says, baby, you ain't seen nothing yet. The powerful forces behind the great gold and silver rush of the 21st century are gathering strength day by day, so I've placed my bets on gold and silver to win. The great asset race we just used as an example is real, and it is happening again right now. Thanks for watching, but this is by no means the whole story. If you want the full story, including my free online-only chapters and companion videos, there's a wealth of information at ggsr21.com. Thanks.